How to identify Delaware statutory trust properties for sale. Real estate investing has always been a hot topic among individuals, but unlike the traditional way of doing things, DST Real Estate Opportunities make it easy for people to create passive income without any actual work. With the right information and some guidance, you can take advantage of this opportunity as well. Luckily for you, Real Talker, we produced a video about how to identify Deferred Sales Trust or DST properties for sale. Remember that while the first step is completing any of these amazing courses, the second and possibly more important step is taking action even if it's imperfect action. If you're looking for an investment that will generate income for your business or certain tax benefits, Delaware Statutory Trust can help. Whether you're looking to diversify your portfolio, complete a 1031 exchange, or generate income, the right DST properties can meet your needs and more. As the number of U.S. investor ages, we've seen upward trends in investment funds being shifted from mutual funds to real estate holdings that are passively held. One such method is through Delaware Statutory Trust. What are DST properties? DST properties are investments in real, physical property. They're typically commercial real estate or other investable assets that can be bought and sold. A DST is a trust that holds one or more pieces of real property. Such as entity is beneficial for investors because rather than owning individual pieces of the property, they can own only a portion. For example, a portfolio of apartment buildings or partnering up with other businesses to open their own DST would be a common investment vehicle for small and medium-sized businesses looking for real estate exposure. The good news for 1031 investors is that certain Delaware statutory trusts are considered to be direct investments in real estate, and they can receive tax deferrals benefits. If the structures of the trust aren't correct, a failed exchange may result. In order to use a 1031 exchange, exchangers must identify replacement properties within 45 days of their relinquished property transfer. They should follow 1-3 ID rules. Number 1. The 3 property rule. Most common. The exchanger can identify 1, 2, or 3 properties without regard to the relative worth of those properties. Number 2. The 200% rule states that an exchanger can identify as many properties as they would like so long as the aggregate value does not exceed 200% of the value of the relinquished property they're selling. For example, if the exchanger sells a property for $1 million, they can identify properties with an aggregate value of $2 million or less. Number 3. The 95% rule states that for a property exchange deal to be successful, the buyer must own at least 95% of the total value of the identified properties. For example, if our exchanger finds 10 properties and values them at $100,000 each, they must purchase 9 worth more than $95,000 in order to agree on the deal. Using the identification rules, a person, company, or trust will only be allowed to count one property. So, if ABC DST has one CVS in Nogales and only holds one apartment complex in Tucson, Arizona, that's okay. However, if there are 4 different cities and they hold each of those cities' apartment complexes, then a DST would need to use the 200% or 95% rule. Choosing the right properties in the exchange market can mean the difference between success and failure. However, finding just the right properties is not easy because they're spread out around the country. To avoid unforeseeable risk, you must learn how to compare different properties so you know what your partner will be giving you. Step 1. It starts with you deciding how much you need, ranging from $10,000 to $50 million US dollars. Then, net debt to adjusted EBITDA is used to determine your loan to value ratio and whether or not you're approved for a loan. Step 2. You may now ask the sponsor how much of the loan payment will take place in the form of interest-only payments. Step 3. Take a look at the debt service coverage ratio. Step 4. Consider the asset and its production expectations. Before making any decision, like investments with a DST private placement memorandum, it's always wise to examine it in detail. When a taxpayer wants to make a 1031 exchange, the identification of DSTs can be confusing and difficult. To be a valid identification, an exchanger must unambiguously identify the replacement property. Some exchanges have their own preference on how they want this to be done. However, since tax advisors differ in what they prefer to see, it's best to consult with your advisor before proceeding with any planning or identification of property that would qualify as a replacement property. Other advisors will request that the percentage of each underlying property in the DST or fractional interest is identified, and other advisors want you to identify the value of each X amount of equity that could be invested into it. When speaking with your tax advisor, make sure you're 100% clear on what exactly the exchange would need for your plan for claiming redemptions. You can also identify DST Real Estate Opportunities by considering these factors. Number 1. Identifying trends. An easy way to identify opportunities is by looking for currently undervalued properties or have a high demand but low supply in the area. Your best bets come from areas with pent-up demand, as homes are not available immediately because they might be new constructions with lots of restrictions on them. Number 2. Through property location. Location is an important factor in any real estate purchase, and it's something that you should heavily consider. For example, if you're investing in DST properties, the best location for your investment property would be outside of city limits. Number 3. With people skills. Good real estate investors need business skills and the ability to network well. If you want to minimize risk, then use an experienced broker or other sources to find good deals quickly. Because you know how important it is to have effective communication skills, the last thing you want to do is find yourself in the position of repeating offers you don't have time for. By taking some time to learn these skills now, when you might not have any opportunities on the table, you'll be that much prepared down the road. Number 4. Valuation of the property. As with any investment decision, your home's value must be considered carefully. Part of calculating a good deal is knowing how much you're paying per square foot and what others have sold for recently, so you know if the purchase was a smart one or not. With that information in hand, it'll be more difficult to assess whether the investment was right simply by instinct, which can be difficult when emotions are involved. Number 5. Investment purpose and investment horizon. Having a specific goal or ROI in mind can make it easier to choose what property you want to buy. For example, if your primary purpose is vacation rental or flipping properties quickly for passive income purposes, then you'll have a different criteria than someone who wants to hold on to their property until retirement. Number 6. Expected cash flows and profit opportunities. Another way to determine if a property is appropriate for you and your family is to take a look at your intended investment's current cash flow and profit potential. If the property meets a certain threshold, that's great. In some cases, properties will not be like this though, so don't worry if one doesn't meet your standards on initial inspection or has other issues. Investigate the home or location carefully before deciding on whether it should be pursued further. Number 7. Indirect investment. If you're interested in investing property but don't want to do it yourself, indirect investments might be the best way to go. For example, if your area is experiencing a lot of commercial development activity, it might make more sense for you to invest as an owner-occupier rather than investor, because the profits from that investment will probably not increase much. This does not mean that DSTs are bad or anything. Number 8. Exchange listings. One way to identify good investment opportunities is by looking at the 1031 exchange listings. You will find companies that have gone through an IPO or acquisition because those companies have already done well and are more likely to succeed in the future. Number 9. Overall real estate market. Always consider the overall real estate market when investing. For example, if interest rates or an economic downturn causes your property value to decrease, that can cause you to lose money. You want to invest in less risky investment at that point. Number 10. Government policies. Before making the purchase, be sure to check any government policy changes since the purchase. For example, if taxation or rental income goes up by 25%, it will be very hard to get good returns in the future, which means you may want to reconsider your decision before going through with this purchase. Number 11. Tax on capital gains. You should also consider the tax on capital gains before making any investments into your new property. This tax applies to profits made from investment, so you have to be conscious of its impact. This is just one more thing that potentially affects your decision when investing in a property, nothing else and nothing more. Number 12. Compliance requirements for foreign ownership. Making real estate investments in certain countries can be taxing. Luckily, there are ways around these rules. So make sure you thoroughly research and talk with a professional who understands how everything works. Be careful though, because if they don't follow the proper procedure, they could get fined or put in prison. They should absolutely do their further homework before making any purchase decisions. These factors are critical for DST investors because they affect everything else about the process. However, knowing what each one does can help investors make more money from their business goals. After knowing all of these, there are also types of investors who should not do a Delaware statutory trust. Who are they? If you've reached this point in the video, it's likely that you know about the many benefits of exchanging real estate for DST, Delaware Statutory Trust, or Fractionalized Replacement Interest. The benefits of the 1031 exchange have been significant, including saving vast amounts of tax due to the ability to defer taxes to a future year, preserving the step-up in basis rule when you die, and moving away from loan guarantees and cash calls. 1031 investors in Delaware can invest $50,000 to fund and assume the operations of actual properties. Investing in a property portfolio provides institutional-grade multifamily apartments, distribution facilities, office space, retail, hotels, and storage facilities. The peace of mind knowing that you'll be receiving a monthly tax-deductible cash flow distribution and having simplified management headaches can make the DST a fantastic option for many real estate investors. Despite its unparalleled popularity, the DST is not for everyone. Some people may benefit from other investments with lower fees. What we're about to discuss are a list of 5 types of investors who will likely want to avoid investing in the DST for various reasons. Number 1. Investors who are not yet accredited. Because investors need to build up their wealth and/or equity before they can invest, the Securities Regulation D prohibits them from entering into a DST arrangement via Securities Regulation D. This rule states that to invest in private placement investments, one must have a net worth of over $1 million, excluding one's primary residence, or annual income requirements of at least $200,000 per year for singles, or $300,000 per couple filling jointly for the last 2 years. Number 2. Younger wealth builders are more likely to be getting started in a business or just starting out on their own. Younger investors might not be ready for a dividend strategy at this point. They may still want to continue following some of their more traditional strategies with stocks, bonds, and cash. Young adults with a desire to invest in their future often find themselves taking on more substantial risk because of the high return potential. There are advantages to this, but also some risks that might arise. If they fail to invest properly and lose money or equity, they usually have more time to recover than someone who is more experienced may. Older investors tend to have a few battle scars, more life experience, and fewer life interruptions than younger investors. Number 3. Do-it-yourself types. Some investors prefer to manage their properties themselves. They have the option of negotiating, managing, and paying taxes on these properties. They also may be better positioned to manage rent rolls, bank loans, and leasing agreements instead of outsourcing it to professionals. A DST is an investment where all of those activities are taken care of by institutional real estate firms. If you're someone that would really miss those types of things and find them significant, you might feel as though the DST solution would be less appealing. Number 4. People who want to get cash quickly. If you're an investor looking for the best investment, then it's important to find out if the real estate is what is best. Real estate investors and other people involved in trading stocks may need liquidity. This makes a 1031 exchange and making an investment in this type of company undesirable for some investors who can't afford the risk of not being able to access their cash. A short sale is the sale of an asset that is worth less than what the seller owes on it. This would allow the investors to invest in more traditional stock and bond portfolios, which can be turned into cash quickly. Financial experts believe that they might need cash to invest in larger leverage deals, the anticipation of a divorce, health concerns, speculation about the economy, or for many other possible reasons. This gives investors high needs for liquidity. Investors love the DST, but it's not for everybody. Number 5. developers, and construction company owners. Construction and development companies can use a 1031 exchange to build their new replacement property with the same company. They get two different benefits at the same time, profiting from their construction company and an increased tax savings by building a replacement property. Individual properties that are to be built will usually have a higher risk-return profile, as well as a better suited buyer in the younger investor. Additionally, individuals may have a certain skill set and knack for certain types of properties such as car washes, storage facilities, dentists and vet clinics, retail, etc. Understanding how to identify DST property, keeping in mind the total number of supplied values for the identification period, and knowing if you can take advantage of these deferral methods will help ensure that an exchanger doesn't run into any ID issues near the end of the identification period. That's it for this video, Real Talker. Remember to subscribe to our channel, and if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon!